Good afternoon. Today, I have one tip to help you increase your investment returns in a down economy. This tip is investing in companies that are known as the dividend aristocrats. The dividend aristocrats are not a very commonly or well-known group of businesses. A lot of investors know about indexes like the S&P 500 or a Shanghai index or the FTSE 100. They're familiar with a lot of different indexes in different countries. But the dividend aristocrats are not as commonly known, and they're usually a little bit better known amongst investors who are known for dividend growth investing, and that's a type of investing strategy. But what I want to do today is I want to talk about these companies in light of a way to help you earn more when the economy is depressed. So right now, even though the stock market continues to make new highs, and we are starting to come out of this, COVID depression, we are still in a down economy, meaning to say unemployment is still higher than it normally is. And the foreseeable future is still quite a bit uncertain. Based on that, it's not a bad idea to own companies that are larger, more established, and have a longer track record of growth. Now, the dividend aristocrats, to give you a very brief snapshot, are defined as companies that have been able to grow their dividends every year for at least the last 25 years. Some of them have grown dividends longer than that. For instance, and I'll give you an example, a utility company called Consolidated Edison has paid an increasing dividend for the last 43 years. So going all the way back to the mid 1970s, they have paid a dividend every year and have increased it without fail. There are other examples of dividend aristocrats, and some of them are big names like AT&T or ExxonMobil or Walmart. And these companies have been able to grow their dividends because they have a business model that has a sustainable competitive advantage. They have what Warren Buffett likes to call a moat. That is an advantage against other companies in their niche that have enabled them to grow over a long period of time and to pay an increasing dividend. Now, how is that important, or why is that important for you? Today, a lot of investors and even professional investors are discouraging the retail investors from putting their money in bonds because bonds don't really pay very high interest anymore. And they may not for some time, depending on how long interest rates are going to be held at close to zero. So what we can do is we can invest in companies that are far more established. Now, you have to recognize that it's still risky. Being invested in large companies, in the stocks of large companies, is not just as safe as being in bonds. However, this is a way to invest for those who want to take a little bit less risk than just being in a broad-based index fund. And I'll give you an example. The S&P 500 has done fairly well over the last 10 years. If you invested in an index of the dividend aristocrats, you would have done well also. However, you wouldn't have quite kept up with the S&P 500 if you look back 10 years. Now, during that time, there were periods of slowdown. There were market crashes, and these crashes could have turned into recessions. One of them did. In 2018, if you remember in December, the market did a pretty significant crash. Obviously, this past year in 2020, due to the COVID pandemic, the market also took a dive, and we had a short-lived recession, and we appear to be coming out of it now. But again, the future is uncertain, so we may go back into one. During those periods where the stock market in general declined quite a bit, the dividend aristocrats held up better. And had you cashed out on them or had you assessed your net worth at those times, you actually would have beaten the market, right? During the times of the down economy, the dividend aristocrats are larger companies. They've been around longer. They're able to weather the storm better, and they're still paying their dividends even during the bad times. You're going to be able to rely on them more during those periods, and hence they're a less risky investment. I don't want to call them a safe investment, but they're less risky. Here's the thing. If you want to invest in them, it's a good idea to put some of your money in them. I'm not recommending that you put all of your money in them. I'm just saying that if you want to balance out your risk, if you feel that you're too risky in stocks, you may want to allocate a little bit more money towards this portfolio. And there are ETFs that you can purchase. You don't have to buy the individual stocks if you don't want to. One ETF that is very common is called Noble, Nobl. That's the ticker symbol. So that is an ETF. Now the expense ratios on these are a little bit higher. I believe Noble is somewhere around 0.35%, right, which is higher than a lot of the rock bottom rates that you can get with Vanguard. But it's still giving you a pretty decent rate, and it's also giving you a little bit more safety in your investments. Again, I'm not calling this safe, just saying it's less risky. And it's particularly good for those who maybe are entering their later years in life. Maybe they are doing a job transition. I know for a lot of military, if you're transitioning out of the military, if you're retiring and you're looking at a way to supplement your retirement income, this is a good way because the dividend aristocrats are big on paying dividends, right? They're big on income. Now, this is a very complicated topic. I'm not doing this as a way to say everybody who's close to retirement or everybody should invest in the S&P Dividend Aristocrat Index. What I'm saying is that it is an option for you if you want to have some risk, if you want to get some income, but you want to somehow reduce your risk a little bit away from the more risky sides of the market, right? Because those index funds have been lifted in large part by a lot of the tech stocks, and those are the little bit more riskier ones. Please post a question or a comment. Send me a private message if you want to talk about it privately. I always enjoy reading your comments. This is again another complicated topic when we get into investing. It isn't a one size fits all. It's a tool to be used. So please post your questions. I always look forward to reading and answering them. And until next time, I wish you unlimited success.